Sentinel One is a cybersecurity company that uses artificial intelligence to provide automated threat prevention, detection, and response capabilities. Of course, given that it's intersection of cybersecurity and artificial intelligence, two very powerful growth trends in markets today, a lot of investors are interested in Sentinel One stock. So, understandably, they want to know what's a fair price to buy this excellent business at. That's the question I'll answer in this video. I'll do a discounted cash flow valuation analysis on Sentinel One to determine what its shares are worth and what's a fair price to buy a share of this cybersecurity stock. Let's jump in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, so here I have my financial model for Sentinel One stock, and you'll notice three different sections, section in green, blue, and red. We're going to start with the section in green, which focuses on free cash flows. The section in blue focuses on the discount rate and weighted average cost of capital. And then the section in red will give us the value of each share of stock, the fair price for each share of stock. If you're a little bit impatient, you can jump to that right away and see what I calculated as the intrinsic value. But let's go in detail, step by step, and go over all of these numbers. So let's start with the free cash flow expectations. So the analysts on Wall Street that are following Sentinel One stock, they think its free cash flow will grow from negative 8 million in 2024, or negative 80 million, I should say, in 2024. And they expect it to turn positive in 2025 and beyond, delivering 20 million in free cash flow in 2025, rising to 90 million in 2026, 160 million in 2027, 310 million in 2028, and 380 million in 2029. Of course, the overall cybersecurity industry will be growing significantly in those next few years. So Sentinel One will be gaining just as a part of the industry rising. And then if it can make gains within the industry to increase market share, it will facilitate even faster growth for Sentinel One. So between 2029 and 2034, I'm forecasting that the company's free cash flow will continue growing. I expect the cybersecurity industry to continue growing for at least another decade or more. The trends are not going backwards. The trends are going forward for this industry. If anything, it's becoming more of a must-have instead of a nice-to-have. And that increasing need for cybersecurity is going to lift free cash flow for participants, especially Sentinel One, which has a pretty good offering in the industry. So I suspect its free cash flow will grow from 380 million in 2029 all the way up to 1.16 billion in 2034, I should say. Okay, so now that we forecast all of the cash flows from 2024 to 2034, it's time to focus our attention to the very long-term future between 2035 and infinity. So in those years, I can use a terminal value calculation to determine what all of those cash flows are worth at 2034. And my long-term expectation is that Sentinel One will grow its free cash flow by a 5% rate between 2035 and infinity. So I expect that after 2035, the cybersecurity industry will still grow, but nominally at just 5%. Specifically for Sentinel One, just 5% from 2035 to infinity. And so the terminal value I calculated is 36.8 billion. So now that we have all the free cash flows forecasted for the next decade and infinity, we can get the value of operations, which brings to the present all of its cash flows expected in the future, and that value of operations is $19.26 billion. So your next question should be, what's the discount rate you're using to discount those cash flows back to today? And that's what we'll discuss in the section in blue. The weighted average cost of capital I'm using for Sentinel One stock is a very low 8.31%. I've applied a cost of debt of 7.5%, and my capital asset pricing model cost of equity comes in at 8.4%. That's because the company's beta is extremely low at 0.65. This indicates that Sentinel One stock price has not been volatile, has been less volatile than the index going back a few years. So the beta of 0.65 lowers the weighted average cost of capital because the beta is an important input to this model, especially because Sentinel One doesn't finance itself with debt, it finances mostly with equity. And so the cost of equity becomes even more important as I've given them a target capital structure of 90% equity and 10% debt because the market cap is 7.7 billion and they only have 20 million in debt. And so for that reason, the cost of equity is that much more important. And Sentinel One has a very low cost of equity. And because of this factor, I've modeled two other scenarios with higher cost of equity, which I'll share with you a little bit later. So now we can go to the section in red where we'll get our intrinsic value per share. We start with the value of operations that we calculated in the green section, and we add the company's cash balance of 660 million, subtract the debt of 20 million to get to the value of equity of 19.9 billion. But we want to know the price per share, so we divide by the number of shares outstanding of 317 million to get an intrinsic value per share of $62.78. This compares well against the current market price of $23.94. The bulk of the price differential is arrived at from the lower beta, meaning that if I change the beta, the stock price changes significantly. My intrinsic value changes significantly. So if I use a beta of 1.25 instead of a beta of 0.65, I get an intrinsic value per share for Sentinel One at $28.60. If I use a little bit lower beta of 1, which gives it average risk, I get an intrinsic value per share of $37.52. So still, even if I raise the beta for Sentinel One stock, I get an undervalued business here. So regardless of the three scenarios I've calculated, my intrinsic value per share shows that indeed Sentinel One stock is undervalued. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.